Hello, everybody. Thank you for tuning in. We are Monday, April the 28th, 2020. It's a holiday in Canada, but I am still on here. And I apologize if there's a ton of background noises because I'm in a cafe and I'm 10 days into a new thing that I'm learning. And I'm here early to try to learn from this group. But in the meantime, I'm also trying to, do my Money Matters episode. So let's get going here. So my name is Huong. I am with Cash Property, and today's Money Matter on April the 28th, we are going to be talking about which makes more sense to get traditional financing or to get the CMHC traditional finance or CMHC financing on multifamily. So what I'm going to do is just check to make sure that we are live on Facebook, because the last time I did this, we actually did not go live. All right, so we are good on Facebook. Okay, so what we're doing today is walking through why this is even a question about going with traditional versus CMHC. So I'm currently right now working on an 8-plex in Edmonton. And so I'm going to be doing the calculation on the 8-plex. But you can pretty much apply this to any multifamily that CMHC will fund, because if you're able to get CMHC, then it might make sense to go CMHC. So this question came up because I'm doing my 8-plex. And I'm like, wait a minute, there's been so many changes with CMHC in the last 2 years that I can't keep up with them. And the last thing that I want as a real estate investor is to be bogged down with rules and regulations and paperwork. And so the question came up as, maybe go with traditional financing. Don't worry about CMHC and all the changes and paperwork and so forth. And so I put the question out there to some mortgage agents, some individuals who I know who are doing multifamilies. And the consensus that came back was, CMHC is better. But nobody actually gave me any numbers to go with it. Okay. And so for me, with my engineering background and me just always understanding the numbers that go behind stuff, I'm like, okay, yeah, CMHC makes sense, but why? What's the numbers behind it? Okay, so that's what we're going to go into today. Okay, I'm going to bring up a calculation sheet that I put together to explain why, in my case, going with CMHC may be a better option for me. Okay, so of course, before you go and take this spreadsheet, or before you reach out to me and be like, hey, Hong, does it make sense for me? Okay, just run your own calculations, check with some other investors and see if it makes sense. Okay, so the gist of it is that at the end of the day, CMHC makes more sense for me, and I'll go through that. And now, if you want more of a deep dive into my calculations and my project in Edmonton and why I'm going this particular path, I would highly recommend that if you're able to attend the EREIA meeting that's coming up in May, I'm going to be presenting there. I'm the keynote speaker, and I'm basically going to be talking about my 8-plex build. And I'm going to be talking about some of the mistakes I've made as I've been executing it. This is really the first infill development that I've done from beginning to end as the main person. So it's very different when you partner up with somebody, you put your money in and let somebody else run it. When you're the person actually doing it and you're accountable for all the numbers and the execution, there's a different level of due diligence there. Okay, so I'm going to be talking about that at the event. So if you're able to attend, this is happening in May. Okay, so let's jump into the calculations here, because this is very relevant for any investors that are looking at doing any sort of multifamily financing, considering CMHC or conventional. Okay, so what I did was I basically just took some of the initial numbers that I had for my project, and I just basically put it down. So I've got my land price at 270. I bought it in cash, so there's no mortgage on it. Okay, the construction cost is 1.67, 1.467. This is the max quote that I got from my builder, and so the only additional cost to this 1.467 number is the GST on the construction. So that's about $73,000. Okay. One of the reasons why I went with this particular company is that the cost per square footage was the lowest that I got across the board. These guys are reputable, they have the experience, and they were able to walk me through the process fairly quickly in terms of understanding it, breaking down the milestones of when payments were due. And that was really important for me because I'm at this point self-funding it. And with CMHC changes recently, and some of the lender changes, they won't advance any of your construction money until you're shovel ready. So the place has to be demolished. You have to have your building permit in place, and you have to be shovel ready. Okay, so a ton of changes that have happened in the last couple of years, and so understanding the numbers is super, super important to make sure that if you're self-financing up until that shovel ready point, that you've got enough cash to execute. Okay, I put 50,000 for financing fees. So this is the 1% to 4% in lender fees for brokerage, for premiums, everything imaginable around the financing portion. So I put that in here. And then I've also got another 50,000 for other costs. Okay. This is not cost that my builder would be covering. So this would be my additional insurance, snow removal in Edmonton, the asbestos abatement, appraisal, okay, environmental studies, any of that stuff would fall under the other. Okay. And it does get pretty close to that 50. I think right now we're at 30,000 with the asbestos thrown in there. Okay, so in total, it's going to cost me about 1.9 million to build. This is a big number. So now I put in here that my desired return is 20%. This number will change for a lot of people. When I invest in somebody else's project, I want higher than 30. I want higher than 20%. Okay, so I'm hoping that my appraisal or my sales price, if I decide to sell this at the very end, is going to be around 2.3. Okay, do I think I'm going to get that? That's a bit on the high end for the neighborhood that my property's in. I might get, I don't know, 2.15, 2.2 maybe. Okay, but that's okay. So now let's jump right into the conventional versus CMHC. Okay, so on both of these, I put down a loan to construction of 75%. Now, this is one of the big changes that came through from CMHC, because at one point they were doing 85, and then at another point they were doing 95. And so if you were getting a construction loan from CMHC, it totally makes sense to go with CMHC because they were giving a lot of money up front to help you cover the cost to build. That's not the case anymore. So what's happening now? So based on the loan amount, okay, so basically I'm taking the 75% times my 1.9. Okay, so that's the cost of me to build this whole project. Okay, so they're going to give me 75% loan to construction on this, which works out to be about 1.43 million, which is great. Okay, but that means that I'm out of pocket 500,000 roughly. Okay, if you do the math on that. So the problem is that if you don't have the money, you're going to have to bring in money partners. So about 477,000. It's just the difference of the 1.9 minus the 1.4. Okay, so about $500,000 you're going to need. Okay, whether it's physical cash or access through a HELOC or some other lending partnerships. Okay, so now I put the rates here. So I put 6 to 4% rate. Now, the construction loans that I'm used to, because when I do private lending for construction, we're at like 9 to 12% for the construction. So to get a 4 to 6% loan here is super amazing. So let's just say this one here is, I don't know, 10%. And then let's say CMHC goes up to 7. Okay. Regardless of the percentage that you use, conventional is always going to be higher. Whether it's 1.2, 3, or 4, it's always going to be significantly higher than what CMHC is going to lend out to you at. So for me, that was a big consideration at the beginning. So To figure out what my interest only payments are for each of those options, I basically take the loan amount times the interest rate that they're going to charge me, and that's it for the year. Okay, so in this case here, for the conventional, it's 143,000 compared to 100,000. So that's savings of almost $43,000 in just interest in that 1 year if I go with CMHC for the construction loan. Okay. The other thing to consider as well with this 43,000 or whatever that percentage is, that dollar amount is that this is post-tax dollars, meaning that I would have had to go out and work at a 9 to 5 or do something else and make 30 to 40 to 50% additional cost money. So potentially like another $10,000 to $20,000 extra just to be able to recognize $43,000. So that's a huge savings right there. Okay, so that's the first thing to consider. The second thing to consider is after the construction is done and you go and change it over to a mortgage, okay, your construction loan is done at that point. You now need to change it over to a traditional mortgage or a CMHC mortgage. Now that's also where some of the calculations really matter. So with conventional, you're looking at usually around 75% loan to value based on either the appraisal, usually the appraisal amount, or what the comps are in that area, or if you're buying it brand new, like, so let's just say I sold this for, 2.2 and that's what the appraisal payment, then that's what the bank is going to use as their amount to take the loan to value against. Okay, so the conventional is usually around 75. CMHC right now is sitting at anywhere from 75 to 95, depending on if you qualify for that 95. Okay, so let's run this at 85% because there's a reason why I'm running at 85%. So if I run the conventional at 75%, I would get a mortgage for 25, 30 years, whatever the time frame is that the conventional lender will give me at 1.7 million. Okay. So keep that in mind that if I get a mortgage at 1.7, I'm out of pocket by about 200,000. Like I haven't been able to recoup all of my money. Okay. And so the 1.9 is how much money I've paid to build this 8-plex. So if I go with a traditional conventional mortgage, I don't get all of my cash out. I actually have to leave some of my money in. Okay. Now, if I go with CMHC at 85%, I would get a mortgage of 1.95. At this amount, I would be able to get all of my cash out. So as an investor, that is one of the things that you want to consider is the hands down, do I get all of my cash out? For me, that's a huge consideration. The other thing is that the difference between 75 and 85% in the value is about $230,000. Okay, that's huge. And keep in mind, this is post-tax dollars as well. Now I can take this and I can go and put it into another opportunity. Okay. So now let's just say I can qualify for 90%. Well, look at this. Now this is above 2 million and I'm going to be able to pull out 343,000, like just from doing that. Okay. So now, of course, this is based on an appraised value of 2.3, which I might not get. Okay. So this is a huge consideration here. So now if I can go up to 95, because in my case, the basement units will automatically be within that low market rent that will allow me to potentially get up to 95%. So if I get up to 95% loan to value, I'm pulling out $450,000 here. That's huge. Okay, like that's the difference between going with a conventional and going with CMHC. Okay, huge difference. Okay, so the other thing to keep in mind is, I've done a comparison basically and just they're not just on numbers, but on the theory behind the benefits of going with CMHC versus conventional. So it's the rates, the premiums, the amortization, any other pros and cons in it. So even though CMHC has this 10-year lock-in with the rates, like I'm in real estate long term, like it's a buy and hold, right? So for me to have to lock in low rents for 10 years, it's not a big deal, especially when the 4 basement units automatically will be within the market rents, but at the low rents. So it's not going to be that much of a hardship for me to maintain this 10-year thing. So the biggest thing for me as well, besides having none of my cash in the project, because at that point, if I have no money in, I'm at infinite returns. Okay. So the other thing to keep in mind is that if you go conventional, okay, if you go conventional and that lender doesn't renew with you for the mortgage portion, or you are not able to go from that lender, that traditional lender, to their CMHC product, you have to go to a different lender to get their CMHC product, right? You are potentially having to pay an additional 1 to 3% increase. Okay, that's huge, right? Like you're looking at another $50,000 on the bottom line if you go with a convention and they don't renew for you automatically. And some of these traditional lenders, they won't offer you a mortgage depending on what their current situation is. Whereas if you go with the lender who offers you the CMHC right from day one, and you're able to get the construction loan with CMHC on it, then you will be able to convert over to their the MLI or another one of their CMHC programs without having to pay this 1, 2, 3 additional fee at the end of the time frame. Okay, so that is what I have in terms of, does it make sense to go CMHC or does it make sense to go with conventional or traditional mortgage? And so for me, based on these numbers, hands down, CMHC is way better. Okay, one, because I get all of my cash out, regardless of the cash flow, regardless of the 50-year amortization, any of that. The minute I'm able to get all of my cash out, the return isn't just 1% anymore. My returns now are infinite because as long as it's breaking even or cash flowing, I've got no deal. And as a real estate investor, that totally makes 100% sense. Okay. So like I said, if you want more information on my project and how I'm handling some of my mistakes in this project, come and check me out at the EREIA meeting coming up in May. I will be there and I will be handing out my wonderful, and along with the Rising of the Rest book, which has 12 amazing authors in there sharing some of our real estate ideas. So that is it for me today. Thank you so very much for watching, everybody, and have a fabulous Monday. Bye, everybody.